It's hard to believe that nearly 2 weeks ago was the extreme fear for Bitcoin and for the stock markets. We've seen the markets rise over this period. Bitcoin just over $12,000 in the last 13 days. Now, it looks like we've seen this sort of playbook play out before at each of the significant lows across the last couple of years. We're going to look at this on the stock markets to give us a forecast for the next several months, and also Bitcoin. The invalidation levels, which are very, very important, the key trigger levels for the price and for time that Bitcoin needs to reach in order for this signal to continue playing out like it has done each of the previous times. We're following a similar playbook yet again. Hit the like button, subscribe to the channel. It's your home of macro cycle analysis. Yesterday, we looked at investors selling at the bottom, selling at the low, and each of the day's analysis builds upon the previous day. So make sure you're here for the analysis. Also, link in the top of the video description and on the homepage is for our free crypto and economic report coming out to you guys today. Make sure you get that sent to your inbox. Just subscribe to that right there. Okay, so the story goes that the sentiment has continued to climb steadily out of those extreme fear levels. We're starting with the stock markets and going through traditional finance before I hit Bitcoin and cryptos to give us a reading, or at least the analysis that I do, on the markets overall. So we can see from the lows here, we've hit extreme fear for several days, and generally the market starts to work its way out of these periods. We start to see higher lows form, and then before you know it, the market's hitting new fresh highs or all-time highs, and investors then think it's time, it's safe to get into the market, and the same thing rinses and repeats. So yesterday we covered how the investors were basically selling out in droves around those lows. We saw it on the volume for the S&P 500, and today I want to look at some of the risk metrics showing that some of these risk assets are potentially coming back, and how gold, being one of the risk off assets, may be going through a bit of a churn here. Just looking at the data points, let's start with the equal weight S&P 500. So we typically look at the capital weighted S&P 500. Here it is, the index, the capitalization weighted. Basically, Apple stock, being one of the biggest companies, is going to be weighted much more heavily for the traditional S&P 500 that we all look at day to day. But just looking at the equal weight, which brings up the lower capitalized stocks at the bottom of the 500, which would mean there is a little bit more risk involved in investing in those stocks rather than the blue chips at the higher end. We're beginning to see the average stock is finally in a relative uptrend. So the equal weight versus the cap, so the capitalization weight ratio, is beginning to climb above the 200-day. There it is, the 200-day moving average, first time above the average in 2 years. This goes back to 2023. So it might be seen that this is a good thing for the markets. I suspect we're going to see higher prices in 2025, as I forecasted, put out in December of 2024. I do one of those posts every year. So if you're not subscribed to X, make sure you do that. Link will be in the video description. Check us out over there. And essentially, we're still seeing the cycle continue on for this period, higher prices. But when the market starts to invest or trade in riskier assets, that's typically towards the peak of the game. We typically see this happen towards the end. For example, on the chart that we can see here, you can see the equal weight was increasing against the cap weight for the first half of 2021. And that was the period that saw the extreme greed. For the second half of 2021, it started to slow down. And we saw that in particular with BTC. We got the peak in April of 2021, then the second peak in November. But by the second peak, basically the risk appetite had left, and we were seeing a slow increase to that next high before it quickly failed. And then of course, 2022 and the rest of it is history from that point. So it doesn't mean that just because we see this, the top's in, this could go on for a period of time, and investors are looking to continue to get higher and higher returns. So what does the research tell us? Generally, it's a positive sign for both indexes that we're going to see higher prices. It shows mostly decent risk appetite, and that's essentially what we're looking for the markets leading into the peak, for Bitcoin, for altcoins if that is part of your portfolio. So we're looking at risk appetite among investors worldwide, which tends to persist. Speaking of worldwide, we're also seeing India triggering several breadth thrusts. Now, I know majority of people don't care what's happening in India. They don't trade the Indian market. They have nothing to do with the Nifty 50. But we're looking at this because it is a very high risk appetite market, being one of the emerging markets of the world. So it's kind of like your altcoin index if you wanted to compare it to something in the crypto space, if that's what you guys are more used to watching here. So the percentage of Nifty index members, so basically the stocks in the Nifty 50, registering a 4-week high surge to 60%, the highest reading since December 2023, most significant reading in over a year. And what happened in December 2023? Well, we got a small pullback, but that's the rest of the move there. It was a pretty big move from those lows in December up to the peak, which happened about 5 or so months ago. So what does this tell us overall? Nifty 50, India's benchmark, yada yada, it's recently shown signs of a potential trend reversal following a 5-month correction. So it went down through 15%, approximately 15%. So essentially we're just looking here that there is an improved appetite for risk returns. That's what we want to see coming back into the market. Now, I know a lot of people have been looking at the money supply increasing globally, but that doesn't mean it's going to happen straight away. There's also been some reasonable analysis showing that it could be a leading indicator, but there can be a period of 3 or 4 months at best that this could take for the market to then absorb that liquidity and then continue up. In the meantime, gold has seen a pretty sharp rise here, and they've played on words here with your sharp ratios. When this has come up, there's typically been a period that gold tends to underperform the stock market, maybe even correct, and in some cases pretty significantly. Now, I don't think we're in the case of 2011 when it peaked at $1,900 and then crashed nearly 50% over several years. It still looks like we're in an uptrend. But it seems like what's happened is the S&P 500 investors have essentially been selling out here, trying to get into gold late after it's already risen about 50% from $2,000, so basically about a year ago. And now they're trying to capture those same gains while the S&P has gone down 10%. Speaking of which, we've been watching the support and resistance levels, in particular the 50%. So you guys should be well aware of this by now, 5,838. Here we are in the last 24 hours, bit of a gap up with a pretty significant rise of 1.63%. I'm looking at this as a bit of a similar playbook to what happened in 2024. So this was the dump into the August low, extreme fear, pretty solid rally out of that low, slightly different. So it's a similar playbook, but you got the dump on extreme fear. You've had the market bounce back. And at the time when it dropped into its higher low, the fear came back. The market thought, well, this is just going to replay again. We've seen the Japanese yen carry trade fear. How could it be all resolved in a matter of weeks? Well, it was, and the market went higher from there. So what we've got at this point is the 3-day down and the 3 weeks down from this point. So I'm still very much watching these signals. Now the area to watch is 5,800 points, closes above, obviously naturally going to be stronger, and it should set it up above each of these previous swing lows, which is in a much better position as well. So any sort of pullbacks from there, probably unlikely going to test the zones from where it has sat, 56.40, these previous swing tops around 57.70. But I don't like the look of the volume that continues to drop off on this particular rally. Now, if you've been following the channel, obviously by liking, subscribing to it, there's a shameless plug right there. You know that we have covered this before. When you start to see this volume really drop off underneath the average, if you can see there, we got this blue line. Make the blue line nice and thick. When the volume drops underneath that, it generally comes back to fill in that price range. So from wherever it broke down, like here, you can see this ran up to new all-time highs. It eventually broke down and filled in that price area. So if history is repeating in some sort of playbook fashion, I suspect we'll see the price come back and fill in this particular volume here. Doesn't mean that I think the game is over. I think it is just a prolonged correction in the market and another good entry opportunity. But the fear would obviously have to return. For the NASDAQ, it has also climbed above the longer term 50%, but it is on its way to test the correction 50%. So 20,800 for a round number. Also lines up here with the swing bottoms. So a good area of support and resistance to test the strength and or weakness of the market. Obviously rejections here, weaker, breaks above, stronger. That's what we're looking out for next. But again, the volume has pretty much dropped off on this particular increase. Now, over to cryptocurrencies, just looking at how things have continued to play out. Another update here for all of our data points for crypto, looking at the exchange volume. It's dropped off again, not by much. Yesterday we're looking at 34 billion, now we're at 33.3. And similar to last time, the same sort of game was played out September, October, November. Basically exchange volume beginning to dry up. But the key thing I'm looking for here are higher lows continuing to form, just to see that at least the space is continuing to hold on to more traders. The liquidations have gone the way of the shorts, more and more shorts getting wiped out as Bitcoin climbed a little higher overnight. Only about $250 million, and I say only, that used to be such a big number, but because we've seen so many days with billion-dollar liquidations, $250 million doesn't really seem too much anymore. The same sort of thing has continued to play out here with the daily exchange volume drying up, and also the search volume has also dried up. So very similar to what has happened before we saw moves up, moves to the upside. That's what we've been covering here around these lows. Now the thing to note is that we're seeing higher lows compared to the previous times. Now I've only got 90 days here, but if we take it out to 12 months, the search volume for Bitcoin is at 34, and back at the lows through October, or really the lows of August and September, the Bitcoin search volume was at 30, 31, and then it started to take off once we had the election, so the US election that came up. Crypto was at 15, those lows are back there at 13. So it's getting pretty damn close to those levels. So time is running out. We've continued to cover that with the fear and greed index as well. So the sentiment is at a point of that base forming and the reset happening. Today we just closed at 46, yesterday 45, so around that fear, but more so getting very close to neutral. And if I show it up here on the chart, Coinbase, we're looking at the time frames here for the market sentiment to reset. So if you have been following, we're watching how the peak of the sentiment to the lows of the sentiment, how long that period has taken. History's shown it's roughly been about 4 to 5 months. So if it's too short, like it happened in 2019, this peak to the trough, that was far too short. It just needed more time. It got into a higher low, and then you started to see the market really climb up and hit greed again. Of course, that's a COVID drop there, but in terms of the time frames, that 4 to 5 month period was a pretty good range to identify where those lows are potentially coming into the market. We see the market begin to overbalance in price and time compared to any of the moves that it had on the way up or down, depending on which direction we're looking at. In this case, we're looking for overbalances in price and time to the upside because we are coming out of a correction, or this could just be a continuation, and that's how you know when it comes to, is it a continuation or are we going to see a change in trend? We're trying to pick the changes in trend here. If it's going to be a continuation, basically a macro continuation, a big move to the downside, you wouldn't expect that these periods would overbalance any of the prior periods. What the hell does that mean? It just means any of the rallies, they're not going to extend beyond the previous rallies in time, day counts, or in price, obviously in this case, the dollars. And so as an example here, $17,000 was the largest increase that we saw on this entire correction. So the peak, 109,000 to the low, 76,500. The biggest rally has been $17,000. That lasted 2 days, but there have been some slightly longer rallies throughout this period. One in particular is 3 days at the top here. This one here was only a single day, another single day, 2 days, 2 days, 2.5 days. We're looking at swings here, not greens and reds, but swings in general. 2 to 3 days. And really, we need to see this thing go more than 3 days. And it has to go further than the price point here, so $17,000. That means we're well into the time period, so it has rallied for longer, but it hasn't broken any of the price extensions to the upside. 17K on the money would be $93,500, which comes in at the 50% level and the swing lows. But we need to see an overbalance, so further than 17K. I'd like to see at least $500, $1,000 more. That's going to take us to about $94,600, and ideally, another $1,500 would take you to the swing top at $95,000. So that's why through this whole period here, we're watching for $93,000 for the market to hit, because that would pretty much balance you with the 93.5 would balance you with the price, but it would overbalance in time. Now we should see a break of the swing and a break of the 50%. That would cover all of our criteria, just like we did with the US dollar. So you've been following the channel on the US dollar. We saw an overbalance in time, an overbalance in price. We saw a breakdown of the swings right here and the 50%. Therefore, there is a very high chance that the US dollar is going to continue down on the long term here. Sure, you're going to get some rallies and maybe some tests at 105, 106, 107, whatever it is, it doesn't matter. It's basically met all of the criteria, which increases the probability that we're going to see further downside. So Bitcoin looking towards those low to mid $90,000 over this next week or two. And I say week or two because that takes us to the time frames here, which pretty much has happened from each of these significant lows. We can take it back to 2023, 2024, 2021, 2020. This one here is to look at the difference on how these markets move. Take it back to 2017. Why don't we do this right now? Like, subscribe to the channel. Let's go through and have a look at how the probabilities could swing in the favor of the bulls if we're going to see a nice rally up to around the mid 90,000s, 93 to 95K, even if from that point you see a correction. A correction from there is going to be probably one of the safest and easiest entry opportunities for BTC. And I say easy because you'd have you would have met the overbalance in time and price, but the fear would most likely come back in if you saw this thing eventuate, this come back down to test some of the previous highs here. Now we saw it in August and September. Big rally up to this price point, 65,000, a pullback into September. That was 20 days into the peak and then 12 days into the low. We got the overbalance in time and price right there, 27th of September. And again, the time frames from the low to the top lasted about 21 days, and then into the low lasted 13 days. So you're seeing more people buying or for a longer period of time than you are on the selling. And it seems obvious when you look back at it now, but if you're in the market at that time, in October, if you're in the market here in September, both of those lows, most thought it was going straight back down and taking out 49. Now calling for each of these lows here, 38K test, $30,000 test. It was pretty much guaranteed in their minds that we're going to see much, much lower prices. But as you can see now looking back, which we talked about in real time on the channel, the videos are all there for you if you want to care to go back and have a look. We had longer in time to the upside, shorter in the corrections. So time was on our side there, and then even on the prices there, it came back and tested the 50% level. So right in here, the short-term 50% there, it came back, balanced it very nicely to the 50%. So just in those two, we're at 13 days now. Should we do something similar, 20 days is going to take us out to basically the end of March. So next week, maybe it runs a little longer like some of the others have done there, 21 up to about 25 days as some of the other examples that I haven't shown you come in at. That would take us into the first week of April. Ideally, for a stronger market there, we need to see it break above 93,500, ideally above this swing top at 95. So I'm really looking towards 95. And that would also break the 50% level. So a couple of closes there. So even if it did hit that, pulled back a little from there, that's going to be okay. It's just a matter of time because I think we've still got some more time there until more of that risk appetite comes back into the market. Now let's have a look at just a couple more examples here of the similar sort of thing here. 25 days up, only about a 5-day pullback there. And if you wanted to use the first range out of this disgusting, fearful period, similar times to now, well, that was 12 days up and only about 4 days to the downside. So you can really begin to see how in the early stages, you're getting a longer move to the upside for the buyers compared to the corrections. So only 4 days there. And then you can look back at this whole period and basically tells you the buyers are stepping in much, much quicker at that point. Now compare this to a bear market where you get very short rallies compared to the downside. 14 days up, 40 days down, same sort of thing happens again. Shorter time up, longer time down, very fast move down here, and a failed rally up lasting longer to the downside than what happened to the upside. So you start to break it up this way. And one more here, looking at the playbook of 2017. This is coming out of the low in late March, 25th of March. That's the date today actually in 2025. So exactly 8 years ago. The low to the top here, 17 days. And then it was just 4 days to the downside. Now, of course, this depends on which exchange you're at. That was a pretty significant move. 1190 down to 900. It might not have been that severe on other exchanges, but I'm just looking at the time frame here. 17 days up, 4 days down, and then the rest is history from that point. Basically pushed away very, very quickly. Now, what else is on our side here? USDT dominance has also continued to grind away here. The thing I don't like about this is it hasn't broken down from the 50% levels yet, so that's not a good sign for the bulls in crypto, and the volume has weakened out on this particular decline here, which means it could have another test at 5.4%, 5.9%, in which case that would lead to our correction again. So we might see a little bit of a grind up, and then this correction would lead to this test to the upside. So that's how I'm putting these charts together to give me a bit of a reading, I guess, over the next couple of weeks. You can see here the volume has been dropping off, but the down volume is a lot less than the weeks to the upside. So there might be one final attempt here. So I'm just playing that out as well. I've got to keep all the options open because at the end of the day, no one knows what is going to happen on the right-hand side of the chart. And finally, the 18-year cycle still in play here. Well, this is a pretty good video that I found on X from David. Go and check it out. Link is in my video description for X, so follow me over there. And it's basically one of the last posts that I have there to explain how essentially the 18-year cycle will repeat, and it won't be stopped until there is a fundamental change in tax policies towards labor and land. Something for you guys at the end of the video here if you're keen on learning more about the 18-year cycle and why it's basically played out like clockwork, like the same playbook. I'm loving to use that title, I think. The same playbook throughout history over the last 200 plus years, over and over again. It's not going to change unless our laws towards labor, our tax laws towards labor and land are changed. Basically a huge fundamental shift, which I don't think will happen in our lifetimes, especially with Trump in power, being a massive real estate guy. Can't see them wanting to tax land and make things a little more equal for the rest of us tax slaves. If you want to learn how to implement the 18-year cycle into your trading and investment plans, whether it's stock markets, ETFs, commodities, real estate, Bitcoin, cryptos, check out TIA Premium. We're going into a lot more detail on how this is actionable within your trading plans. I'll see you guys back here at the next video. Until then, take care. Peace out.